everybody, and welcome to this Economic Impact Update. Today is March 14, 2022. My name is Martin Gagnon, and as usual, I am with our Chief Economist, Stéfane Marion. Hello, Stéfane.
Hi, Martin.
Let's start with the talk of the town. Stock markets are down more than 10%, Stéfane.
Yeah, the stock markets took a hit. More than 10% is called a correction, Martin. As you can see on the slide, it hasn't happened often. It's actually the first time it's happened since the pandemic first hit us. The cause of the correction, Martin, however, is much different than what we've seen over the past couple of years. It's mainly caused by geopolitical stress coming from this invasion of Ukraine by Russia, which took the world by surprise at the end of February.
And Stéfane, we have to say that the markets were not forecasting this, and so were we not forecasting this. So it happened, and it had quite an impact.
Yeah, I mean, our baseline scenario was that, given the global supply chain, the integration of all economies, we thought that Russian leaders would find it economically not viable to launch such a large invasion, but it is the case, Martin. So we were surprised, obviously. And the type of geopolitical stress that we're living right now is the largest in a generation. It's just as acute that as it was during the collapse of the USSR in the early 1990s. So quite the stress at this point in time.
And obviously, energy prices.
Yeah, if you're going to hit with the second largest oil producer in the world with economic sanctions, there's going to be an impact, Martin. You can see that on this slide. The blue line shows you the price of oil in nominal terms, crude oil that is, and the red line shows you the price of oil adjusted for inflation, to give you a sense of how we compare with previous oil shocks. So what we're facing now is quite significant. Oil prices have more than doubled. Last time we saw this type of event was in the 1970s. Oil shocks took place, 2 oil shocks during the 1970s, which had a significant impact on the global economy.
And Stéfane, there's a correlation with the oil and the price of food.
Yes, and the interesting component, Martin, on this, the observation actually is that if you look at the price of food adjusted for inflation, we're actually back to the all-time high that we saw in the 1970s. So it's a double whammy for consumers as you are impacted both on energy and food prices.
Mm-hmm. And let's talk about a long word that we have not used in about 40 years. What is stagflation?
Yeah, so when you hit food and oil prices like we've seen recently, people talk about stagflation. Stagflation, Martin, last took place in the 1970s. An easy way to define it is when your inflation surges above your unemployment rate, and then at some point your unemployment rate starts to drift higher. And as you can see on this slide, this had not happened since the 1970s. So yes, that is a testament of the hit that consumers can take during these types of period.
Now, when we do these parallels with the 70s, Stéfane, we need to be a little bit careful because the behavior of the consumer has changed.
Yeah, or you could argue that its vulnerability to higher food and energy prices has been somewhat lessened. And you can see on this slide that back in the 70s, food and energy prices accounted for roughly 22% of the consumption basket. Prior to COVID, we were at 11%. So Martin, it will drift higher, but the ability to absorb the higher food and energy prices is somewhat enhanced this time around, particularly in a context where monetary policy is still very much accommodative, whereas back in the 1970s, the central banks were fighting against the oil shock and raising rates, even though there was not much we could do as an economy to absorb that. So I think that the central banks have learned their lesson and hopefully will tread more carefully.
And obviously this has had an impact on consumer confidence.
Yeah, and trading more carefully, Martin, means taking into account that consumer sentiment has been hit pretty hard as of late. So we're down to levels that are quite low by historical standards. And since the consumer accounts for 60% of US GDP, or close to 70%, Martin, yes, the central bank will have to be careful. So I know the market is pretty much very aggressive right now, pricing a lot of rate hikes, but I think the Fed will have to be careful and the Bank of Canada also, Martin, and on how to modulate against the supply shocks.
So what should we do, or what's happening during all of this? Well, once again, Canada is a place to hide.
And Martin, it's an interesting topic because a lot of people are saying, what do you do if you see uncertainty due to oil shocks? I mean, do you find refuge in fixed income markets? Well, with central banks hiking rates, with more inflation, not sure. So one defensive play that you can look at is, from an equity market perspective, if you think the central banks don't go overboard with the rate hikes, is that Canada has played a defensive role so far. Canada's the only stock market in the OECD with Norway, Martin, is actually showing positive return year to date, mostly because of its commodity sectors.
Let's look at them, Stéfane. We're seeing interesting prices across the board.
Yeah, people like to focus on energy alone, Martin, but there's more than that. Price of metals produced in Canada, new all-time high. Agricultural products, new all-time high. Forestry products. So by and large, what that means is that it helps sustain profitability of our corporation. So the stock market has provided us with positive returns year to date in Canada, but it's also a reflection that profitability is also improving.
And with profitability, we can hire more people.
Yeah, you're absolutely right.
Creating jobs.
You create jobs. You can invest more, the ability to invest more, or create jobs. And the February jobs report was just phenomenal, Martin. More than 300,000 jobs, new all-time high. Full-time jobs, new all-time high. So that positions the Canadian economy, to be in relatively decent shape, as you see, or relatively good shape, I should say, as the central banks consider hiking rates. So again, there's an ability here to absorb some of the impact from higher food and energy prices, which is a form of taxation for consumers right now.
And for the first time in 2 years, we were almost ready to do this without talking about COVID-19, but we have to end with this.
Well, we won't, because, Martin, there's the energy shock, the food price shock, and then it is true that Omicron variant seems to go away right now, seems to be going away in the OECD economies. Having said this, Martin, China still keeps its zero tolerance towards COVID. Over the weekend, they've announced that they were shutting down Shenzhen, the city of Shenzhen, which is a major industrial production center for the global economy. So again, Martin, we have a triple whammy right now. We have energy, food, uncertainty about the central banks, uncertainty about the military conflict, plus COVID, zero tolerance in Asia that will impact the global supply chain. So there's still, I think, the fundamentals for the global economy are still relatively sound, but there's significant shocks that have been hitting us recently.
Thank you, Stéfane. In conclusion, I guess that we can summarize by saying definitely uncertainties have increased. We're not in the recession camp, Stéfane. We're lowering our projections, and we're still calling for 4 rate hikes this year in Canada and in the U.S.
So you're absolutely right. We're less aggressive than market expectations, just to account for the impact of the multiple supply shocks that we're facing right now. So hopefully, Martin, monetary policy is still accommodative and they don't bring this in restrictive territory anytime soon. So that's the good news at this point in time, but we need a solution to this military conflict in Ukraine.
Excellent. Thank you very much, Stéfane. Thank you for listening to us. We will be back in 1 month. Take care.